All right, welcome to This Explainer, where we are diving headfirst into the dramatic collapse of the massive PayPal and Stripe deal. And honestly, decoding what this actually means for the payment giant's future. If you've been paying any attention to the fintech space lately, you know that PayPal is standing at a historic crossroads right now. So today, we're going to break down exactly how we got here, and more importantly, where the company is headed next.
So here is our roadmap for today. We've got 6 parts: the $50 billion breakup, the market reality check, PayPal's solo turnaround plan, the risks and roadblocks ahead, catalysts for a comeback, and finally, the bull versus bear case. Let's just get right into it.
Section 1. The $50 billion breakup.
Okay, so back in July, a consortium led by Stripe and the private equity firm Advent International made just a colossal bid for PayPal. I mean, we're talking about a monumental offer here that valued the company at over $50 billion. That broke down to roughly $60.50 per share. For a hot minute there, it really looked like the entire payments landscape was about to be fundamentally redrawn. But then, well, it all fell apart.
So why did it die? It basically came down to 2 main reasons. First up, a massive price disconnect. The consortium offered that $60.50, but PayPal's board flat out rejected it as too low. They were reportedly holding out for a valuation closer to $70 a share. But honestly, the second roadblock was probably even more daunting: regulatory red tape. Think about it, merging Stripe with PayPal's Braintree unit would create this absolute mammoth of an entity, processing nearly $3.7 trillion a year. That kind of head-to-head overlap meant antitrust regulators would have scrutinized this deal relentlessly. So the consortium walked away.
Moving to Section 2, the market reality check.
When the news broke that the deal was off, PayPal's stock immediately plummeted. It dropped 13 to 15%, basically overnight, settling down around $51 to $52 a share. What happened here was the instant erasure of the takeover premium. Basically, investors who had bought in purely on the hype of a buyout, they headed straight for the exits. The price snapped right back to reality, reflecting only PayPal's standalone fundamentals.
And if you want to know how Wall Street is feeling right now, the caution is palpable. Out of 43 analysts covering the stock, a whopping 33 are issuing a hold rating. Compare that to a tiny fraction, just 4 analysts, who are actually saying buy. And ironically enough, the average price target they've set sits right around $60.50, which is exactly what the consortium just offered.
Because of this big drop, PayPal is now trading at roughly 9 times forward earnings. To put that into perspective, that is a steep discount. It's historically cheap, especially when you compare it to its fintech peers. The opportunity is absolutely there, but for us as investors, this metric sends a really clear message. The market is demanding concrete proof of a turnaround before it jumps back in.
Which brings us to Section 3, PayPal's solo turnaround plan.
So, without a buyer, how does the new CEO, Enrique Lores, fix the ship? His survival strategy basically rests on 3 massive pillars. Number 1, drastic cost reduction. They are planning to cut roughly 20% of the workforce over the next couple of years to save about $1.5 billion annually. Number 2, operational focus. They're restructuring the whole company into 3 focused divisions: checkout, consumer products like Venmo, and crypto. And number 3, which is absolutely crucial, innovation. They are going all in on new areas like Fastlane, their one-click checkout, and really pushing their crypto capabilities through a partnership with Paxos.
We actually got a sneak peek at how this is playing out in their Q2 numbers, and it's a bit of a mixed bag. Revenue did grow 5% to $8.68 billion, and total payment volume rose a really healthy 10% to $486 billion. But here's the catch: operating margins actually contracted. So yes, the top line is growing nicely, but underneath the hood, the current business model is still showing a lot of friction.
And this timeline right here, this reveals the ultimate tension of the PayPal story. Those massive $1.5 billion cost savings we talked about, they're heavily back-end loaded. So the restructuring starts now, sure, but investors are going to have to hold their breath through a long transition period in 2025. You really won't see the true financial payoff hit the books until 2026 or maybe even 2027.
Section 4, the risks and roadblocks ahead.
That long wait brings us directly to the severe risks facing this turnaround. To see how the biggest players are viewing this, just look at institutional holdings. You have just 76 hedge funds holding PayPal right now. Compare that to a massive 181 hedge funds holding Visa. That contrast is incredibly telling. It tells us that the smart money is perfectly happy to sit on the sidelines and watch this play out rather than placing a bet today. And honestly, beyond that institutional skepticism,
Lores faces some pretty monumental headwinds. First off, execution risk. It is sky high. Everything hinges on him proving these cuts will actually re-accelerate growth. Second, the competition is just fierce. I mean, think about how often you just double-click the side of your phone to use Apple Pay. That frictionless experience is exactly the dominance PayPal is fighting against. And finally, they're dealing with sluggish macroeconomic pressure, especially slower travel growth and soft demand over in Europe.
Section 5. Catalysts for a comeback.
Now, despite all that gloom, it is not over yet. There's some very distinct levers PayPal can pull here. For starters, they're sitting on an absolute fortress of a balance sheet with $13.5 billion in cash. They can easily use that for aggressive share buybacks to support the stock price. Next, if stablecoin adoption takes off, they are perfectly positioned with their crypto expansion. And the real wild card? Sources are saying the Stripe Advent consortium hasn't completely ruled out coming back. If the stock stays cheap and the turnaround shows even a little traction, they could very well return to the table.
Section 6. The bull versus bear case.
Ultimately, this all boils down to a clash of two very different perspectives. The bull case looks at PayPal and sees a phenomenal, deep value play anchored by a globally recognized brand and a fortress balance sheet, with a plan that could deliver massive upside by 2027. The bear case? Well, they see a company burdened by extreme execution risk. They see a legacy giant fighting for its life against fierce competition, where the actual payoff is just way too many years down the road to justify jumping in right now.
So, that leaves us with the ultimate question as you do your own research. With the takeover premium wiped out and the standalone fundamentals laid completely bare, are we looking at a deeply discounted turnaround opportunity for the patient investor, or are we just trying to catch a falling knife in an increasingly crowded and ruthless payments world? It's a highly fluid situation, and these next few quarters are going to be the real test. Thanks for joining me for this explainer, and keep learning out there.